For every action in nature, there is an equal and opposite reaction. This is what Newton's third law of motion states. Similarly, in the stock market, every action taken by a company has an equal and opposite reaction on the stock prices. For example, when Zee announced its merger with Sony Pictures in September 21 to create India's biggest entertainment entity, the stock price of Zee jumped by 39% on the date of the official announcement. But when the merger collapsed between the two companies, the stock price fell by more than 30% in a single day. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of personal finance. In this video, we'll be discussing the 5 most common corporate actions and how they impact shareholders and investors like you and me. But first, let's start with the basics. Actions initiated and approved by the company's board of directors are called corporate actions. This could include dividend announcements, stock splits, bonus issues, buyback of shares, merger acquisitions, and so on. Some corporate actions like the rights issue and the open offers require shareholders' approval, even if the board of directors have given in principle approval. So you surely need to keep a close eye on these actions, as they may have either positive or maybe not so positive impact on your investments. Now let's dig in deeper to understand what these corporate actions mean and how they impact your investment values. The first one is dividends. So when a company decides to share a part of their profit with the shareholders, it is referred to as dividends. For example, ITC recently announced a dividend of 6.25 per share. This means that if you had 100 shares of ITC, you would have received 625 rupees in dividends. Now typically, when the dividend is paid to eligible shareholders, the stock price often decreases by an amount equivalent to the dividend payout. This decline occurs because until the dividend was paid, the cash was part of the company's balance sheet. Once the dividend is distributed, the stock price adjusts to reflect the reduced size of the balance sheet. Many times, you may not see the decline on that day because the stock price gets adjusted a few days before or after the dividend is paid. Looking at the daily chart of TCS, you'll notice that the stock price has typically declined in the days leading up to or following the dividend distribution. Now, back in the 1990s and 2000s, when FMCG companies sought to expand into rural areas where purchasing power was lower than in the cities, they repacked their top products into smaller sachets to make them more affordable. This strategy worked for them and gave them additional revenue sources. Similarly, as the price of a stock rises, retail investors tend to avoid the stock due to its high price. As a result, trading activity declines, resulting in lower liquidity in the stock. For example, the stock of MRF has a price tag of more than 1.2 lakh rupees. Most retail investors could be avoiding it for its high price. So whenever the management of the company feels the same, they decide to stock split. There are no fundamental changes in the stock. A stock split enhances the liquidity in the company's share and makes it more affordable, particularly for retail investors. For instance, Persistent Systems recently announced a stock split in the ratio of 2:1, meaning one equity share with a face value of 10 got split into 2 equity shares with a face value of 5. When the split was announced, the stock was trading at 7,921 rupees. After the split, the share price got halved and is now trading at a reduced price of 3,290. Like dividends are a form of cash rewards distributed out of profits, understand bonus shares as stock dividends distributed out of accumulated profits or reserves by the company. When companies have surplus reserves on their balance sheet, they often opt to distribute them to shareholders through bonus issues. This strategy helps to avoid the inefficiency of having excessive cash reserves that are not being utilized effectively by the company's management. Now, after the bonus issue, the stock price declines to the extent of the bonus ratio. For example, in April 2022, Varun Beverages made a bonus issue at 1:2 ratio, which means that 2 new shares were issued for every 1 existing share held by a shareholder. On the day of the bonus announcement, the stock traded at 1,064. After the bonus, the stock price was adjusted to 375 per share. So when the bonus shares are issued, the number of shares the shareholder holds will increase, but an investment's overall value will remain the same as before. However, now since for the same market value of shares, there are higher number of shares, the earnings per share goes down. When a company buys back its own shares either from the open market or by approaching existing shareholders, it is referred to as share buyback. Shares bought back are typically cancelled by the company. This is done to lower the share capital or number of shares available in the market. Companies opt for share buybacks for the same reason they pursue bonus issue, to reduce the excess cash in their balance sheet. But unlike bonus shares, in share buyback, since the number of shares are reduced, the earnings per share of the company increases. As the EPS of the company rises, it potentially increases the stock price due to earnings growth. Now, what will you do if you run out of money and need to make an urgent requirement? Well, you'll either approach your family or friends, right? Similarly, if a listed company needs funds without increasing its debt burden, it can turn to its existing shareholders to raise additional capital. This process is known as rights issue. Generally, the shares offered under the rights issue are issued at a discount as compared to their market price to make it attractive for shareholders to subscribe. But the impact on stock price is varied, and it all depends on the purpose the fund is being raised for. If the shareholders are not convinced about the growth plans and the rights issue does not get fully subscribed, then it can hammer down the stock price. And this was all about the corporate actions and how they may impact your stock investments. Hope you liked this video. Don't forget to subscribe and press the bell icon for such interesting content from us.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.